Hey, Sharon, Thomas here. Hope you're doing well. Just thought I'd give you a little tutorial of the numbers I'm going to send you. I thought it'd be helpful for you to be able to watch it yourself before we do a conference call, but happy to do a conference call as well, but just wanted to quickly go over my numbers with you. So basic assumptions, about $9 million cash from your sale, capital gains tax of $2 million. I ran a couple different loan scenarios, all at 5%, one at 20-year amortization, and actually I ran another one at a 25-year amortization. But overall, I think what we should keep in mind is that my analysis is an annual income analysis. So if you're comparing this to stocks or other types of investments, you should compare it on like a dividend basis as what the investment is actually paying you annually in terms of cash on cash invested. So that's just something to keep in mind as we're going through this. So we'll go to summary here. Basically, I ran 5 different scenarios. One is pay the tax, so $9 million less $2 million, is $7 million. Scenario 2 is do a 1031 all cash. The difficulty here is trying to find properties that equal $9 million. If you're under $9 million, you're going to pay a little bit of boot on tax on the boot. And if you're over $9 million, you're either going to have to come out of pocket or do a small loan. So this option's a little bit tougher to do to puzzle piece the properties together. Scenario number 3 is the current 3 property portfolio. It does not include the Verizon. So this is the Fresenius, the O'Reilly, and the Dollar General in Florida. And this is $9 million equity invested, a small $1 million loan. And then scenario 4 is a 25% loan to value. So that'd be a $3 million loan for a total purchase price of $12 million. And then scenario number 5 is a 50% loan to value. So $9 million equity, $9 million loan, total purchase price of $18 million. And I don't think you're probably going to want to do this, but I just wanted to kind of show you the numbers on it in case you wanted to. But here's the net annual cash flow on the different scenarios. And again, this is annual cash flow, cash in the bank paid to you every single quarter, every single month, etc. It's not hypothetical returns like in the stock market where stock's going to go up 3% a year and pay you 4% a year cash, so that's 7% a year. This is actually true cash return on cash invested. So scenario number 1 is fairly low, and we'll go over the details, but the 2 highest are scenario number 2 and 3. Scenario number 2, 518, and scenario number 3, 496. The 3 middle scenarios all meet your 475 goal. So that's just something to keep in mind as we're going through here. And then these are the true cash on cash yields, this number divided by this number. And total annual return is taking into account principal reduction after the tenant pays down your debt. So let's move on to scenario number 1. You have $9 million cash, you pay $2 million to the government, and you have $7 million to invest. The 10-year U.S. Treasury right now is paying a little under 3%, so your return would only be $192,000 a year. And that, T-bills actually I don't think pay annually, so this is more of like a long-term investment at 3%. But a REIT does pay quarterly, typically, or sometimes even monthly. The National Association of REITs pays an average cash dividend of 4.3% over the last few years. So on $7 million, that'd be 4.3%, $300,000. But on $9 million, because you're giving that money away in tax, it would reduce your overall return. So this is like apples to apples. This would only pay you 3.3%. And another option, just to look at it this way, to invest the $7 million in other properties, pay your tax, get your basis adjusted, and invest in other properties or another alternative investment. So I'm using that. This is kind of the Florida cap rate, 5.76%. And that the return on the $7 million is the 5.76%, but the return on $9 million, which is what you started with, is only 4.5%. So I'm not sure this option would make the most sense. Maybe you have other needs for this $7 million, or you want to split it up or do other stuff with it. But $2 million invested at 0.0576, that's $115,000 a year of income. So if you pay the tax, you're walking away from over $100,000 a year in income by paying that tax. In over 10 years, that's of course 1.1 million, and in over 20 years, that's 2.3 million in income that you just totally miss out on because you pay tax on that. So that's the main benefit of a 1031, is being able to defer this capital gain tax, reinvest it, get that $115,000 a year of income, and be able to keep controlling this money indefinitely until you pay the tax at some point in the future. Option number 2, this is the all cash. Again, if you bought an $8 million property, you'd have $1 million of boot, and you'd have to pay tax on that $1 million. And if you're at a $9.5 million property, obviously you'd have to come out of pocket for the $500,000 or get a small loan. So I think scenario number 3 takes that into account more so than this. But this is just if we could find a perfect $9 million property, or a $8.9 million property, or a $9.1 million property using that Florida cap rate, that's your annual cash flow to you, net cash flow, $518,000. And again, I think that's the greatest of the options. But this one's kind of hard to achieve in the real world unless you found the exact perfect property or perfect blend of properties. And again, if you bought some properties in Texas, or blended Florida and Texas together, we could get this number up. And I think if this was a 6 cap, you'd be at $540,000. So that's just something to keep in mind. As cap rate goes up, obviously your overall return is going to go up as well. Scenario number 3 are the 3 properties we are working on right now. Total purchase price a little over $10 million, small loan of $1 million. Here's the NOI, which actually equals the cap rate. $578,000 is what you're going to be getting in, but then you'll have a principal and interest payment of $82,000, and that will equate your net cash flow to just under $500,000. So that net cash flow of just under $500K on $9 million is 5.5%. And once you reduce the principal, or the tenant reduces the principal for you and pays that loan down by 31%, your total return goes up. It goes above the cap rate and above your cash on cash return to 5.8%. So that's where you start to get the benefits of leverage as that principal gets reduced and the tenant pays the loan for you. And you're essentially getting the spread, the interest rate spread of the 0.76% over the 5% interest on that $1 million. So as you borrow more money, your overall returns, your total returns are going to go up, and you'll see that in the next scenarios. Scenario number 4 is a 25% loan to value. Lenders will easily do 60% loan to value today. So a 25% loan to value in this case is a $3 million loan, and I use 3 different cap rate scenarios. The Florida cap rate scenario is the 5.76%. Blended, maybe 1 or 2 properties in Texas would be 6%. And then all these or properties outside of Texas, or excuse me, outside of Florida would be like a 6.5%, even higher, 6.75% if we really wanted to. But again, the cap rate pushes up the NOI accordingly based on what you're buying it for. Your debt service stays the same, 5% interest, 20% amortization, and then your net cash flow goes up accordingly because of the cap rate, because your income's higher. And your cash on cash goes down a little bit in this example, and it will go down even more in the next example because more money is going to service that debt, the principal and interest. But then the tenant is paying down that debt, in this case $90,000 a year, which then juices this total return up to 6%. So instead of a 5 3/4, you're all of a sudden at 6% because you borrowed some money. And then as your cap rate goes up, obviously these go up as well. So if you buy at a 6.5% cap rate, once the debt is paid down by the tenant, your overall return, annual return, is a essentially a 7% return. But these do kind of start to eat into your overall cash flow. And I think to meet your 475 goal, you'd have to get the blended cap rate up, which might be a good option here, this 6% blended cap rate on a 25% loan to value. And then the last and final scenario is scenario number 5, which is a 50% loan to value. I don't think you're going to want to borrow $9 million, but I just wanted to throw it out there and show you what you could do and how that affects the numbers. We could definitely do Walgreens, CVS, and get 25-year amortization, non-recourse loans and be able to make that work. But we might have to start looking outside of Florida to do that. And we definitely have to get into some bigger price points. But here is your NOI, which goes up over $1 million because your purchase price is $18 million. And then your debt service is higher, obviously, because you're borrowing $9 million as opposed to $3 million or $1 million. And then your net cash flow actually starts to go down in this case because, again, you're servicing more debt, but then the tenant is paying more principal for you. So that really juices the overall total annual return. But this for you might not work because it really eats into your annual net cash flow. So 423, 466. And I think this is a more realistic example, or these two, which is they are both under your 475K threshold you're trying to hit. So you can see the cash on cash goes down, which is this 423 divided by 9 million, or this 466,000 divided by 9 million. These are the lower end of the cash on cash, but then again, you start to get the juice of borrowing money and getting that leverage because you're getting a spread of, let's use this example, 6% cap rate on a 5% interest rate. You're getting 1% a year spread on money that's not even yours. That's borrowed money. So then that starts to juice your overall yield. You're buying at a 6% cap rate, but then your overall yield, you're getting 1% on the borrowed money, and then the way it equates is you're getting another 0.25% blended value on the principal and interest pay down. And then again, on the loans, you can deduct all the interest as well. So that's just something to think about of your income taxes. I don't think this is going to be an option you want to do, but I just wanted to show you how you start to get into benefits of leverage here. When you borrow more money, you start to get that spread, 6.5% over 5% interest rate. That's a 1.5 of yield on money that it's not even your money, and it really juices that return to an 8.25%. It's attractive to a lot of people, but there's definitely risk and costs that go along with it. And then you'd have refinance risk because this loan would take 25 years to pay down. So you'd be looking at a pretty big balance in 10 or 15 years still. And then one other thing on all these scenarios is doing a 1031, you're still going to get the benefit of depreciation. So let's go back to the main screen. On all the scenarios 2 through 5, you're buying real estate. You can 1031, obviously, defer the tax, and then you can depreciate anything new. You talk to your accountant, of course, but you can depreciate added improvement cost that you buy. So you'll get more tax benefit on the real estate purchases, whereas you're not going to get depreciation on other alternative investments. And here, once you pay the tax, you can't 1031 that money anymore. On any of these scenarios, you're doing a 1031, deferring the tax, getting the benefit of the $2 million now, but then you can also sell some or all of these properties later and then 1031 again as needed. So that's just something to keep in mind of doing a 1031 and the benefits of it versus paying the tax. But overall, your goal of 475 a year, the three middle options, 2, 3, and 4, meet that goal for your net annual cash flow. This is after debt service. And then if you start to look at it in terms of overall yield on that $9 million, the best option is not taking a loan. That equals your cap rate, 5.76%. Again, that's Florida cap rate. This number would go up if we did a blend at 6%, something like that. Same here. This number would go up if we did a blend at 6%. But scenario 3 meets your threshold, but then you start to get the benefit of the leverage here, $1 million. And then even more so, you're still meeting your threshold on scenario 4. You're borrowing $3 million, getting $482K of net cash flow. And then your overall return goes up to 6.36%. So to me, one of these 3 scenarios would be the best, it seems like, for you. Something to keep in mind is just the rate of pay down and refinance risk. Obviously, the lower that you borrow or the less refinance risk you have or the quicker pay down you could do. We could easily set this loan up on like a 15-year amortization or a 10-year amortization and get that paid off really quickly. And then you just own everything free and clear at the end of, let's say, 10 years. This is a 20-year pay down, these numbers, and I did these numbers on scenario 5 at a 25-year pay down. So that's just something to keep in mind of that amortization essentially equals a free and clear property at the end of it. So that's just another thing to balance. But looking at it here, seems like you'd get the most benefit in the real world from not trying to buy a $9 million property exactly, but actually doing a small loan from $1 million to $3 million is a good risk threshold, and you start to get the benefits of interest and principal here, and the leverage. And but I think that's it. Hopefully this was helpful, and if you have questions, let me know, and happy to do a conference call as needed. Thanks. Have a great day.